G'day everyone, it's Stefan Angelini here from the Investor Types podcast. Thanks again for tuning into another episode. This is a special one where we're talking about strategy and particularly how you can get into a share portfolio without actually using any of your cash and actually protecting all the downside. So if you lost money, you would actually not lose any money. This podcast is really interesting for people who want to invest into a share portfolio or have one and want to invest more, who don't want to use their own cash to do so, and that have extra cash in order to meet higher debt repayments when they come up. So the conversation is about using a combination of margin lending as well as put options in order to get into these kinds of products. That's a fixed term investment horizon that could be suitable for a lot of people. Now, before we get into it, I just want to remind you one little thing. This is just general information only. Please don't consider this as personal or financial advice, but if you are considering a strategy like this after listening to it, just reach out to your own financial planner. Hopefully they'll be able to point you in the right direction. If you need to reach out to me, please email me at investortypes@gmail.com. But without further ado, let's get into the episode. G'day folks, thanks for joining us for another episode of the Investor Types. We're talking with Nathan Free from Bell Potter Securities, and we're talking about something that people don't know you can really do that much. And I'm talking about investing into stocks with no cash. People always ask, I don't have the cash available to start investing. Can I do it? A lot of the times the answer is no, but in this instance, the answer is yes, you can. Is that right, Nathan?
That's correct. Absolutely.
Beautiful, mate. Well, thanks for joining me. I want to get right into it. Can you tell me, so how would someone invest into a portfolio of stocks with no cash?
Through our geared equities investment product, we will lend investors 100% of the investment amount. So unlike investing in an investment property or investing in a margin loan where you typically put a deposit down or a portion of equity, we're lending investors 100% of that position.
Right. So that's it. They borrow the whole money, invest it. Sounds risky. How risky is it?
It's through a limited recourse borrowing arrangement. So we hedge out the position in the background. So what that means, we effectively use puts on our side, but the investor doesn't have exposure to those. Effectively, from their point of view, if they borrow $100,000 to invest in shares, each individual plot of shares is protected against any downside movement from a capital perspective. So, and that's individual protection as well. So if one stock goes up $100 in value and another stock goes down $100 in value, normally you would net off and you'd be back to even.
Yep.
But with this product, because it's individual stock protection, you'll cancel out and walk away from the loser and you'll just take the winning $100. So it's quite a powerful proposition.
Wow. Okay. So I normally associate limited recourse borrowing arrangements with borrowing from banks to buy properties through super. And essentially what it means is that even if it did lose money, is that the banks can't come and chase your personal assets. So there's a protection piece there. But with the way you use options or the puts to protect the downside and to say that, well, even if the asset did lose value, you're not actually going to lose any money as an investor. I mean, that's quite powerful.
So it's principal protected, absolutely. So you can't, no matter what happens, if you invest, say, $100,000 in the market and that falls in value to $50,000 and you've effectively lost $50,000, you're protected from that capital move. So you can't lose anything from a capital side of things. So the only downside might be potentially the break-even costs. So that's a great thing about this product. You know from the outset what your maximum downside is. That can be set largely in advance. It's basically your interest cost less the dividends that you receive from stocks, the associated franking, and any associated tax deduction as well. So that works out and you know basically what your worst case scenario is, and it doesn't matter what happens to that stock. Obviously you want it to go up so you make a profit, but you can't experience a capital loss.
Yeah, okay. So but you said before, so if I've got multiple investments and stock A goes down, stock B, C, and D goes up, well, you just cut off stock A, which is lost, but you still get the benefits of B, C, D, E.
Exactly right. Hand that back at the end. No harm, no foul. You don't experience that loss at all, and you just take your profits.
Okay, so that means it can go into multiple. I love that. So, look, you said before, so you get dividends because you're investing into shares, so you get the normal franking credits that any investor would get. However,
Correct.
Doing something like this, using options and puts, sounds quite expensive. Can you explain to me some of the costs that are involved in doing this kind of strategy?
It's not going to be the same cost as, for example, a margin loan.
Yeah.
The problem with the margin loan, though, is if the market falls 10, 20%, you're likely to experience a margin call, be forced to sell out, or be forced to put more money in, or have your other assets exposed. So yeah, look, we've definitely got that protection piece in there. So the interest rate typically is more expensive. Your costs are simply your brokerage, and then your interest costs. Now, your interest cost will vary depending on the risk presented by the investment scenario. So a shorter term investment will be more expensive. So 1 year will be more expensive, significantly more expensive than 2 years, and 3 years will be cheaper again, as an example. And the volatility of the stocks that you pick. So if you pick, for example, a Qantas obviously fell recently 75% or something in value.
Yep.
That means that our hedging costs in the background for us to buy a put to protect that position is going to be more expensive than, say, a Woolworths, which has been experienced a low volatility with everyone buying toilet paper and going crazy at the supermarkets. Their price hasn't changed too much. So volatility's been low. So yeah, depending on the portfolio that you pick, and so that means the pricing and the interest rate is specific to each portfolio.
Okay. All right. So you got mainly, so the in cost, which is the brokerage, the in and out costs, which is sort of like a set brokerage cost. Then you've got the interest on the loan, which is one component. And then you've got an interest on the option or the put, which is another option, which tends to vary a bit more.
So we don't break it up. You do just have the one interest rate. It is all combined. And we have a tax ruling in relation to that as well. But I mean, that interest rate is going to vary depending on the cost of capital. So the cost of cash at the moment is very, very low, extremely low. So that side of things is very low. But then there's the cost of the hedging side of things. And that is probably at the higher end at the moment, considering all the volatility we've been experiencing. It's certainly cheaper now than it was, where are we, May, June? So, 6 weeks ago when things were absolutely plummeting, those volatility spiked and those protection costs spiked as well. So, and the pricing will change day to day. But we bundle all of that, the interest cost into one.
Yeah, okay. And you spoke before about the extra risk you take if you've got a shorter period. So with these kinds of options or trading, how long can I take these investments forever and use this forever, or is there a finite time you have to have?
So the contract for the GEI contract is either 1, 2, 3, or 4 years.
Okay. Yep.
At the end of 4 years, you've got some options. So if you're losing stocks, the ones that have not gone up or have gone down, you hand those back. No harm, no foul, no brokerage to pay, walk away from them. The profitable stocks, you've got a few options. You can, let's say you had that $100,000 portfolio of stocks, and let's say it had turned into a $200,000 portfolio at the end of 4 years.
Mm-hmm.
You need to give us back that 100,000. So the first 100,000 needs to come back to us.
Yep.
You can work out a way to fund that. You might move it over to a margin loan because you've got a 50-50 LVR.
Yeah.
You might take that $100,000 off your home loan. You might have 100,000 sitting there, and you might just take full ownership of that whole $200,000 portfolio.
Okay.
You might instead hand back $100,000 of that portfolio to us, close out that position, and keep that 100,000 in profit as shares.
Mm-hmm.
You might keep that 100,000 as cash.
Yep.
I mean, so you've got the ownership and you've got full discretion as what to do. The other thing you might do is you might take that $100,000 that you owe us and roll that over to a new GEI. So you might roll this over again, start a new facility. You've got your 100,000 in profit, whether you're taking that as shares or cash, it's up to you. And the portfolio of 100,000 in shares, you might roll that over to a new GEI facility. So yeah, it's quite flexible.
No. Okay. So even if I've got a 4-year term facility and I think I've got a few investments that have run their race, and therefore, I'm happy to get out now. Let's say it's after 2 years and I've got a 4-year term facility. Would I be able to get out at year 2?
You can, yes, we do give that option, but look, I'm not going to misguide you here. It can be quite expensive, depending on how long's left.
Because you've got break costs.
Yeah, there are break costs, and they can be significant depending on how long's left. I like to use a rough rule of thumb of about 5% per year that's left, but that's certainly, it's not scalable, and that's certainly not what it is. But if you keep that in mind, it's going to be pretty close to reality. Mm-hmm. The thing is, what we're doing is we're hedging in the background, and we're recouping that cost over the term of the contract. So if we spend all that money in year 1 to hedge that position through buying puts, and then you walk away in year 2, we need to recoup the cost of that protection that we would have recouped over the last 2 years. So look, it certainly is possible to walk away, and there's other strategies we can do that get a bit more sophisticated, and that they can, in that kind of circumstance, they talk to you as the advisor, and we can work through those ways to do it, which won't necessarily incur that big break cost.
Yep.
If you're entering a GEI, you're entering it with the mindset that you're really expecting it to hold it to term.
Yep.
But you do have the option to walk away midterm, and even for losing stocks. For the hedging, we use American put options. American compared to European put options mean that you're protected throughout the term. So if you get halfway through a 4-year term, one stock's $100,000 down, and you go, you know what, I just want to get out of this. Things are happening. I don't want to have this facility anymore. That stock's never coming back. Look, there's going to be a break cost, as I told you, but you're still not liable for that loss. You don't have to hold the contract to term to have that protection kick in. The protection is there throughout the whole contract.
Yeah, okay. And look, you can draw a comparison to people that have an investment property and they fix a loan with the bank for a 3-year term. You want to try and get out. The bank's going to go, well, no, you can't get out. If you are going to get out, we're going to charge you some break costs. It's as simple as that. It's an easy way to draw a comparison. But you're doing all the hedging behind the scenes, which makes it a little bit trickier for you.
An added layer, yes. Yeah.
No, 100%. Look, so what people have to understand is that these aren't the cheapest things going around because of the running costs, essentially. Like, because you've got not only the brokerage, which is in and out cost, you've got the other interest rate, which it's not just a normal trading facility, because you've got the hedging, because there's so much work going into it. So with these costs, though, am I able to claim a tax deduction for these costs?
So the ATO allows basically what they call the reference or benchmark rate. At the moment, that's currently sitting at 6.098%, so we'll call it 6.1%. So up to that point, you can claim, and look, it's also subject to the individual's tax status, so they need to seek personal tax advice. But most investors will be able to claim a tax deduction up to that 6.1%. If the interest rate is above that, let's say it was 7%, as an example, 6.1% they claim as a tax deduction against their income. So they reduce their income tax. The other 1% or 0.9% extra, that would go towards the cost base of their investment, which would mean if they make a profit on those stocks, that would reduce the tax they pay as a capital gains tax. Okay. Or if they didn't make a profit on those stocks, it would carry forward as a capital loss, which could be offset against future capital gains.
Okay.
So even though there is that limit of 6.1%, there is still tax benefits for any interest you're paying above and beyond that.
Okay. So let's say someone makes a gain and they've held it for 2 years. Typically with holding an asset, you can claim a 50% capital gains tax deduction when you hold it for longer than 12 months for an investment. Does that still apply to these products?
Absolutely.
Okay. All right. Well, good. I like it. So look, it sounds quite interesting. In a low market, something like low rates, a market that's come off a lot, there might be a lot of people that are interested in this. Who are the main people that you see investing in through this kind of structure? What are the main investor types that you see come across your desk, and where does it fit?
Yeah, sure. I mean, I've done this myself. I did this a couple of years ago, and I've actually got an application. And this is something I'd say to you as well. If you've got any interest, get your application in early, because you don't want to be seen as a great opportunity to buy and needing to apply on that day, because it can take, depending, if you get all your documentation to us, it might take a week or so, a few days to set it up. So I've got mine set up, ready to go, waiting for an opportunity this end of financial year. But I did one a couple of years ago, and I was in the process of buying a home. So we had a significant amount of cash sitting there for the deposit. And I wanted to be in the market. I thought there were good things going on in the market, but I didn't want to touch that cash in case I needed it. So I was able to leave that cash sitting there, go take out a GEI 100%, not putting any cash down, use my monthly salary to go towards that, and get into the market. So we see that a lot where people have, whether they've got cash sitting there they don't want to touch because it's for a specific purpose, but they want to be in the market and experience the upside of these growth assets, particularly, in the market now, people are getting quite excited with the fact that we've had a major correction. Might be that somebody has a lot in property, all their money in property, and they want to diversify. So they want to diversify into equities, but all their money's tied up in property, or all their money's tied up in. We see this with executives of companies. You might have an executive who gets shares. They might get $2 million worth of shares in their company. They're all locked up in it. they can bring that $2 million worth of shares, depending on if the stock's on our APL. They bring those stocks over to us. We can then release that equity, so they get the $2 million back to invest in the share market and build a diversified portfolio rather than being stuck in one asset.
Yep.
We see it very commonly in young professionals, guys who are starting to make good money, but they haven't really built a big capital base behind them. So they know they should be in the market. They want some tax-effective investments. They want to get that exposure and be in the market. They know they can afford to manage it on the monthly repayments, but they just don't have that $100,000 sitting in the bank account to get in. And we see it looking in professionals, 40, 50, even right up to pre-retirees, guys who are looking for, particularly around this time of year. We probably do, to be honest, about 80, 90% of our inflows over this month of June. And that's part of the tax planning strategy. So, it forms part of a smart tax planning strategy while also getting a genuine underlying exposure to the market and growth assets and trying to make some profit.
Yeah. So when you see clients, if you've got on the highest marginal tax rate with those tax deductible expenses, you're able to claim something in the 40s back, as opposed to if you're a lower income earner, you're able to claim something in the 30s back. So that you get that little bit of extra benefit where you are on the higher marginal tax rate, but it doesn't necessarily have to just be for those people. The amount of the different kinds of people that you just explained is, fantastic. I understand how it applies to all those people, but for those people out there who are wanting to get into this and might want to buy a property in the future, I guess it is borrowing, so it is going to be assessed if you are going to borrow something in the future. So just make sure you talk to the right financier about it. What you said about the application and getting applications in throughout the start of coronavirus, there was a lot of people that wanted to go and withdraw on margin loans to get into the stock market. However, talking to people from the banks who are in these departments, they were too busy making margin calls to be able to process new applications. So if you didn't have your application set up, you weren't moving. So you're right. Getting on the front foot, getting everything set up to be ready to pounce whenever the time's right. I think it's amazing. So Nathan, if there is someone out there listening to this who thinks that this is applicable to them, how do you think they should get into something like this?
Look, it is a sophisticated product. So I wouldn't recommend a layperson to come and just invest directly. They need to talk to a finance professional, somebody who's got experience with lending to invest as well. Someone like yourself, Stefan, someone who's experienced in guiding not only on the investment side, but taking into consideration those risks of borrowing to invest, and can, I guess, put it as part of their overall investment strategy. Yeah,
100%. So if you are looking to get into something like this, look at it as part of your overall investment strategy. Yeah. It's a structure. It's a great structure. It's something different. It's what a lot of people wouldn't know out there. So Nathan, thank you so much for your time, mate. I really appreciate you coming on and explaining this to us. I know I'm more educated after it, even though I know a lot about it. For anyone out there who's got any questions about it, feel free to reach out to me, stefan@angeladvisory.com.au. Otherwise, if you've got any comments about it, feel free to leave a comment below. This is on YouTube as well as on podcasts. So Nathan, I'm going to leave it there, mate. Everyone out there, thank you for listening. Thank you for watching. Nathan, thanks a lot for giving up your time, mate. I really appreciate it.
Thanks for having me. Enjoy your day.
Bye.